IFRS 9 is the new accounting standard for accounting for financial instruments. It perhaps has the most significant effects for companies in the financial sector, but it is in fact a cross-sector standard. And that's because if you look at your balance sheet, you'll have trade receivables, trade payables, intercompany loans, and bank loans. And all of these are financial instruments, as are derivative contracts that you might take out, for example, interest rate swaps or foreign exchange forward contracts. So the scope is very wide indeed, and it's going to go across all companies in every sector. Starting with the measurement requirements, IFRS 9 brings a slightly different mix of amortized cost and fair value measurement, meaning that balance sheets might change a little bit and there might be a different type of volatility in the profit and loss account. As well as that, for some financial assets, there's a requirement to measure them at fair value on balance sheets and at amortized cost in the profit and loss account. And so there's then a requirement to have dual records. We also have a new hedge accounting model which links more closely into internal risk management processes, and so companies might be encouraged to use hedge accounting more. But the big headline is on the impairment model, where instead of having an incurred loss model where something has to have happened before you make a provision, the new model in IFRS 9 is an expected loss model which requires you to look forward and look at macroeconomic and other data, really looking into the future to see what you expect to happen and what the expected effect on the recovery of your receivable balances will be. Certainly it's going to be significant. The forward-looking model means that you look at macroeconomic data, really forecasting the future. And for financial institutions with large loan and mortgage books, this is very, very significant indeed. In fact, this one part of IFRS 9 has been described by some financial institutions as being a more significant change than the entire adoption of IFRS from local GAAP about a decade ago. So in that sector, it is very, very significant, and we've seen projects at large financial institutions that have been running now for a couple of years. If you come into the corporate sector though, while the effect is less significant, it's still very marked, because again you have the same principle that you need to look forward at macroeconomic data, you need to look forward at your forecasts and projections of the future and consider what the effect in your recoveries is going to be like. It looks similar to the old general provisions model, but in fact it's quite different and significantly more complex to apply. The changes to hedge accounting have been designed to make the accounting standards requirements link in more with the way that people run their own business. And that's a very welcome change. It means that if you look at the way that risk is managed by companies, then typically it will now fit much better with the way that the accounting standard operates. So in that way, I would expect that it may encourage people to hedge account where they haven't before. And in some cases under IAS 39, people have commercially managed risk by taking out derivative contracts like interest rate swaps and forward exchange contracts, but they haven't bothered to hedge account because it's just too difficult. So they may now start to hedge account. It may also encourage other companies that were put off by the profit and loss volatility that they would otherwise have got now to enter into those contracts, because IFRS 9 will make it easier to match the gains and losses on a hedging instrument, typically a derivative, with gains and losses on the hedged item, whether that's now measured at fair value itself or whether the gains and losses in the derivative are deferred and recognised later at the same time as the hedged transaction. IFRS 9 has got very extensive transitional provisions. They are complex and detailed, and they have a lot of reliefs which are really designed to make it easier to adopt the standard. It's one where, although some projects don't really need it, this is one where you really need to look at the transitional provisions early. A key date is the date of initial application, which is the first day in the current accounting period in which you adopt the standards, so the start of the current year, not the comparative year. And it's on the date of initial application that you need to make elections for a number of the options and the reliefs that are available. And because the effect of those options and the reliefs will not just be at transition, but they'll last for a number of years after the date in which you adopt IFRS 9, it's necessary to give quite careful thought to the ongoing future effects as well as the immediate ones. You need to be able to understand the overall effect in the financial statement. So what's moving from fair value to amortized cost or vice versa, what's the effect? The real headline though is what's the effect of the expected loss model? And that's one which is going to need a lot of work and a lot of careful analysis. And linked to that, where's the information coming from that you're going to use in calculating expected losses, and how are you going to make sure that that's consistent period on period going forward? There's also the question of hedge accounting, and are you going to hedge account where you didn't before, and what's the effect of the new approach? Because there are some differences in the detail which can result in significant differences in the numbers reported in financial statements. That then takes you to external communications, because you don't want to surprise the markets. So how will you brief the analysts? How will you brief your brokers? How will you avoid headlines appearing in the papers about the adjustments that you didn't tell people about? So that's really the overall message of getting things done, working out what the changes are, and making sure they're communicated early. The first one is really based on the sheer complexity of this standard, that you need to allow sufficient time. We're seeing in practice that already in the financial sector, companies are really starting to struggle, that parallel runs that they'd planned for the second half of 2017 are now being put back into 2018 because the projects are taking more time than they'd expected. Linked to that, you need to ensure that you have sufficient specialised resource. IFRS 9 in particular is quite a niche standard. Financial instrument accounting is complex, it's difficult, and there's a relatively small pool of people who really understand it. So there's scarce resource that you have to call on, and that means that it's always also going to be a real challenge to you. Also a real challenge is getting the input from the board and the audit committee. These are difficult concepts in this standard, and both of these groups of people need to understand them so that they can ask awkward questions appropriately. So you really need to think about how you're going to take the key messages to the board and make sure that they understand it. It's also necessary to think about how you're going to get these numbers into your first financial statements. What you really want to do is to minimize the extent of out-of-accounting system changes that you make. So things like calculations in Excel spreadsheets that then get added as what you might call period 13 journal entries. And that brings an increased risk of error. It also brings a need going forward to embed those external processes into your accounting systems. And because the reliefs in IFRS 9 mean that to an extent, some of the work that you're required to do is more straightforward on transition than it is on an ongoing basis, this isn't just a transition project. This is one where you have a project for transition, and then you have an ongoing project for a couple of years afterwards to get it bedded in properly into your processes and systems.